Hi, everyone. I'm Mike Pacito with IM Global Partner. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. We believe with DBMF, we have designed the ideal solution for accessing the managed futures category, delivering meaningful diversification and overall alpha generation to traditional stock and bond portfolios. DBMF combines an index plus replication approach with low fees, providing investors an elegant, efficient, and effective ETF. In doing so, DBMF applies long-term strategic allocation benefit to asset allocators. I'm joined as always by Andrew Beer, co-founder of Dynamic Beta Investments and co-portfolio manager of DBMF. We'll be touching on performance, some recent interesting rotations related to current positioning of the strategy, macro commentary, and a bit more color, and a few more tidbits along the way. This update should clock in at around 10 minutes. We appreciate your time and hope you'll find it well spent. So with that, Andrew, I hand it off to you.
Thanks, Mike. So here's the quick summary. DBMF was down slightly in July on both a price and NAV basis, marginally ahead of both the SocGen CTA index, hereinafter the quote hedge fund index, end quote, and Morningstar US trend systematic category, hereinafter the quote Morningstar category, end quote. As we talked about last month, I am pleased to report that after a frustrating first quarter of this year, the strategy is back to doing what we hope it can do over time, potentially outperform both hedge funds and mutual funds with high correlations to the respective indices. In essence, provide a way for investors to get something that looks like index plus performance over time. That's essentially what DBMF was able to achieve since launch in 2019, outperform meaningfully in 2019, perform in line in 2020, then outperform by a decent margin in both 2021 and 2022. For professional investors, please feel free to reach out to Mike, as he can show you related performance back to mid-2016. In any case, we are cautiously optimistic that our investors will look back 3 years from now and see, much more of this, much more satisfying pattern of results. On the macro front, we've taken to calling this the impossible market, not of the fake burger variety, but rather because things that most strategists and investors assumed were extremely unlikely have come to pass. We cite a few examples on the upper right. For instance, I just haven't found anyone who predicted the Fed could hike 500 basis points in 18 months and not cause a recession, or that unemployment would remain this low and yet inflation would recede by this much, or that the taper bet would be flat out wrong, yet growth stocks would absolutely crush value. Or if you remember in late March, where the media breathlessly reported that a massively inverted yield curve was a foolproof indicator of impending recession, by June, no less. And yet the economy seems just fine 4 months later. Last month we talked at some length about all the macro near misses, using the metaphor of a drunk stumbling across the highway. But to make matters even more irritating to the smart money crowd, if you got the macro call right, e.g. persistent inflation, figuring out how the markets would react has been something of a wild card, e.g. growth kills value. So a lot of playbooks have been torn to pieces. And given how, as the physicist Niels Bohr said, it's difficult to make predictions, especially about the future, we think the name of the game today is to diversify across asset classes and strategies, especially into strategies like managed futures that can be nimble and have the ability to adapt to these big shifts in the macro landscape. And speaking of nimble, on the positioning side, we do see meaningful dynamic rotations in the portfolio. We'll highlight some of the big moves in a few slides, but for now, our current positions are that the euro will rise and the yen will fall. Essentially, a bet that Europe has some catching up to do on the rate side, while Japan will sit on its hands. Unlike many fundamental hedge funds, we're long the S&P 500 against EFA, non-US developed markets, essentially bet on growth over value and US market supremacy. We're short treasuries, a position that should benefit from any upside surprises on the inflation front, yet have abandoned our long gold position, perhaps underscoring how gold has worked better as an inflation hedge in theory than in practice. Lastly, we basically flattened the crude oil short, which may reflect a lower probability of recession. So to keep this moving, let's jump to the next slide. So once again, here's our regular slide since inception versus the S&P 500 and Bloomberg Ag titled Portfolio Diversification Bang for the Buck, quote unquote. Since launch in 2019, we've delivered nearly 1,000 basis points per annum of alpha relative to the S&P 500. And so to make a slightly more nuanced statistical argument, approximately every dollar that DBMF has generated since inception, 44% over a little more than 4 years, has been alpha. So compare that to a stock picker who's a hero for delivering 100 basis points of alpha a year net of fees. Or compare DBMF to bonds. A dollar in bonds since launch is still worth about $1 today, even including interest, while you have $1.44 in DBMF. This math means that with a 10% allocation to DBMF since inception, alongside stocks and bonds, you could have preserved returns while materially reducing drawdowns. Essentially a big step toward the goal, I think, of all financial advisors of helping clients to retire with as much money as possible with the least amount of stress along the way. And so one follow-up point on the macro discussion, the performance of bonds this year has been really disappointing. In January, many were calling this the year of the bond. And this was really based on the taper thesis that falling rates would provide a nice tailwind. And yet, treasuries are down for the year, and credit, while up slightly, is underperforming cash. So to harp on a theme, a rational and self-aware allocator will acknowledge that it's very difficult to know where we go from here. So the real question is not whether to diversify, but how best to achieve it. And I challenge anyone to find a strategy available in an ETF or mutual fund that can deliver the kind of alpha generation described above, especially through a crisis like last year. So if you want to talk about strategies for allocating this space, so that clients understand why it's in their portfolio, what they should expect, and how to make it a successful long-term allocation, please reach out and let's have a discussion about it. Next slide, please. Okay, so here's our usual slide with performance since inception against both the hedge fund index and Morningstar category. So just to take a step back and to remind everyone, when we got into the managed future space 7 or 8 years ago, we wanted to create a quote index plus end quote product. We basically didn't want to take a flyer on last year's star or build our own trend following models, which can vary widely depending upon how you turn the dials. So, replication was the best thing we came up with. We don't think it's perfect, but we think it gets closer to that objective than the other options. Essentially, one or a few single manager funds or one of a handful of multi-manager products. Plus, it's a relatively inexpensive way to invest. We're happy for everyone to see our positions every day, which means it can work well in an ETF. So the punchline of this slide, over 4+ years of live performance, we think the strategy is doing what it's supposed to be doing, deliver a high correlation to both the hedge fund and mutual fund indices while outperforming through lower fees and trading costs. So our pitch is that the strategy overall is a great diversifier, and we think we built a simple and elegant way to get exposure to the space with the transparency and efficiency of an ETF. If 5 years from now, we can point to a 90% correlation and consistent alpha generation, we think DBMF can serve as the quote default end quote allocation for many advisors and model allocators. Next slide, please. Here's our standard chart on volatility adjusted positioning. As a reminder, we show volatility adjusted positioning since it can be confusing when looking at notional position sizes. What looks like a big position in something like the 2-year treasury might be less risky than a small position in crude oil. So this helps to make the exposures a bit more apples to apples. And this month, we're showing it relative to 1 month ago to underscore how dynamic the portfolio has been recently. To start from the left, we've gone from a very short crude oil, which we interpreted as a recession hedge, to close to flat, while flipping from long gold, in theory, a good inflation hedge, to short. Both shifts make sense in the context of a market less concerned about either recession or runaway inflation. On the currency side, our core position of long the euro and short the yen remains intact, albeit with a sharp reduction in the yen position, as the Bank of Japan has made noises about a shift in policy. On the rate side, we're now short treasuries across the board, whereas after the mini banking crisis, we flipped to long the 10-year, but kept the shorter and longer duration shorts in place. And on the equity side, managed futures funds have increased long exposure to the S&P 500, which makes sense given the persistence upward trend since last fall, while shorting EFA and flipping from a small short position in emerging markets to long. So I'm going to be really interested to see how this one plays out, because several months ago, long EFA versus the S&P 500 was a big trade among fundamentally driven hedge funds. The thesis was that higher rates would benefit value stocks, and there are more of those outside the US these days. While the extreme outperformance of US markets in the 2010s would reverse in the 2020s. That trade has not been going well recently for those hedge funds. And it looks like managed futures funds rotated out pretty quickly and have been on the other side of the trade recently. So time will tell who's right here. So with that, I'll hand the baton back to Mike.
Thanks, Andrew. So summing up, we view DBMF as a long-term allocation. We also believe that we've designed a superior solution to accessing the managed futures asset class. And finally, we believe that there are few, if any, more compelling diversifiers to traditional stock and bond portfolios than managed futures. So our closing slide here tells the story of how successful the strategy has been, very simply with these bar charts showcasing the since inception performance of DBMF versus the index, which we seek to replicate, plus by eliminating most of the fee drag. It also contrasts DBMF's performance against the category average, but as defined by Morningstar. Outperformance against the index has been 200 basis points annualized since inception. Outperformance against the Morningstar average has been over 380 basis points annualized since inception. We believe these results are convincing, and we hope you do too. Combination of effective index plus replication with fee reduction being the purest form of alpha are the key characteristics of what makes DBMF unique and compelling. So closing here by saying thanks to all of our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com. Until next time, from DBI and from iMGP, thanks for spending time with us.